Okay, hello everybody. Welcome to Korean Atlanta Mentorship. So we're going to do another Velocity Banking video, and hopefully after you click this video, you'll understand that Velocity Banking is super duper easy. So what is Velocity Banking? All it is a debt payoff strategy using a line of credit as your main operating account. And what is a line of credit? It's a financial tool where you can borrow money, pay back, and then use it over and over again. So you probably have a credit card, that's a line of credit, but there's other types of lines of credit like personal, business, home equity, and we're going to use that as our main operating account. So we're going to do Velocity Banking. We're going to do two things, or we're going to need two things. Number one is a budget, and then number two is a line of credit as our main operating account. Now, there's actually two things we're trying to prevent, or we're trying to not do when we're doing Velocity Banking, which is to save money, because all of our money is going to be applied to debt. So if you ever heard the advice from Dave Ramsey, save $1,000, that's going to be incredibly hard when we could just put all of our money into debt. And then the second thing that we're not going to do is to segregate our income. So if you ever take a look at anybody's expense breakdown, they probably have debt. And what's happening with most people is that if they use their checking account as their main operating account, what's probably happening is they're paying a couple of credit cards, a couple of loans, maybe a mortgage, and they're splitting their income in many different places. And I got people emailing me their budgets, their real life case studies of what's going on with their finances. And then you can see right here, this person's got like a ton of debt and their income is being segregated all over the place. And then you take a look here, oh my goodness, another case study of that, right? So we got a ton of debt, or not a ton of debt, but we got our income segregated, and it would be so hard to be in this position to save $1,000. In fact, let me go ahead and cue the AI British voice to kind of re-emphasize what I just talked about.
In order to understand something, sometimes it is best to understand what it is not. So let's ask the question: what is not velocity banking? It would be two things. Number one, saving $1,000 as Dave Ramsey suggests in his first baby step. Number two would be segregating your income.
All right, so we're definitely not going to segregate our income, and we're definitely not going to save $1,000. So let's go ahead and do the velocity banking side of the budget. So instead of saving money, here we have $100 of savings. We're actually not going to save any money at all, and then we're going to have these expenses right here, right? Okay, and then we're going to have, instead of savings, we're going to have cash flow, right? And so you might be thinking, savings, cash flow, what's the difference, right? Well, at the end of every single month, if we're doing this right, we're not going to see any money in our savings account because all of our money is going to be applied to debt with the help of a line of credit, right? And then we're also going to assume that we do have a line of credit. So maybe about, I don't know, $50,000 balance available. And let me actually clear this. So $50,000, it's kind of like a credit card. We could either assume it's a personal or home equity line of credit. But here's the most important thing when it comes to credit lines or lines of credit: you need to get it before you ever need it, right? And so there's a saying that I like to hone in and say over and over again, that banks don't lend money to people who need it, right? Banks don't lend money to people who need it. And so if you take a look at here, I got these two huge credit lines, $280,000 and $15,000 here. So kind of think of this as like you go to the bank's website and I could just click a button and then they'll give me like 10 grand, and the total limit will be up to $280,000. But I click a button and then bam, 10 grand in my checking account, and I can use it however I wish. Now, what we're going to do is, this example is use it to pay off debt, right? But let's just assume we have a $50,000 limit, okay? And what we're going to do is maximize this cash flow number. And then once we start doing that, what we're going to do is the actual strategy, which is to put your entire paycheck into that line of credit, and then you take your expenses out of that line of credit, right? So that's all we do. And then this will go, our cash flow will essentially reduce the balance of that line of credit plus a little bit of interest. And we always try to minimize that line of credit interest by putting our entire paycheck, which will bring down the average daily balance. Now, let's go ahead and take a look at this. And then if I go put this to 0, to 0, to 0, right? The only way I can do that is essentially by transferring these three credit cards, which is going to be 43,000, that's the only way we can do it. So go to zero. So basically, we're doing a debt transfer. We're not getting rid of the debt yet, but by simply transferring the debt and putting, what will happen to these payments is that they go away. And so we literally went from $100 of savings a month to $1,500 of cash flow, without even, I guess, in the blink of an eye, without even trying, right? So just by allocating how we use our money and what's our main operating account, right? We are able to increase our cash flow, and we can only do that by doing two things: by not having any savings and using our line of credit as our main operating account. So let's go ahead and do the calculations how long it'll take us to pay off that operating or that debt that we moved to the line of credit. So what we do is we take, to get the next month's balance, so we take the previous month's balance plus the previous month's interest minus our current cash flow. So this will vary from time to time as we pay off more debt, 1585.13. Okay. And then what we got to do, right, is we got to take the average daily balance. So we take the average of these two numbers here, multiply it by the interest rate, which is 0.1, and then you divide by 12, because interest is quoted annually but calculated monthly. Okay, so let's go ahead and do that. And then what we do is just copy and paste this. And then we see that all of this credit card debt is going to take, well, is being eliminated, but we don't have that much cash flow to begin with, and not that much income either. But let's go ahead and do this, and we see that it takes about 31 months to eliminate this income, or not this income, to this debt. I'm sorry, I'm sleepy right now, but it takes us 31 months. So let's go ahead and highlight this right here. So one of the things you might notice as you see these demonstrations is that the higher your income, even though you're paycheck to paycheck, you're in a better position than someone who's, let's say, has a lower income and more cash flow. It's kind of weird how that works, but that it's true. It's true. You could see it in other videos where, like, I got $10,000 of income and I'm negative cash flowing, like negative $500 of savings, and the debt payoff so much easier, right? So always try to make more income, but the whole point of this is that if we inefficiently allocate that income, then we're gonna have tough times. So let me just go here. So basically, we spent almost about 3 years. So 36 months is about 3 years, and then so now it's 31 months. So let's mark that as a milestone. So 31 months, and then that will be 43K, which is not bad, but a little bit more than 2 years, and we only have $1,500 of cash flow. So we were in a very tight situation, living paycheck to paycheck. We're doing a little bit better, but again, if this were me, I'd probably try to find ways to make an extra $1,000 a month, just so that I don't have to wait less than 3 years. Probably do it within like 6 months if it's possible to get rid of. Well, I don't know if 6 months for 40 grand of debt is possible. Well, I did it, but I'm not the average American bear. Okay, so now what we got to do is pay off these right here: student loan, auto loan, mortgage. And when you're dealing with amortized loans and sometimes even lines of credit, you got to figure out there's a debt payoff order, right? And let me just quickly go over this right here. So basically, this is like traditional way of paying off debt, which is figuring out, oh, what's the lowest balance, highest interest rate, and highest payment, and figure out loans or debts that fit all three of these criteria as much as possible. But the thing I like to use, and one of the reasons I became a fan of this, is because once people started sending me their spreadsheets, I was like, I'm so overwhelmed. How do I figure out which ones to pay? And then, you know, I was taught something called the cash flow index formula. I didn't come up with it. Where basically what you do is take the balance of the loan divided by the monthly payment, and then it's going to spit out a number called the cash flow index right here. And the lower the number, that's the one you want to pay off. That's what it means. And the reason why you would want to pay off the auto loan first rather than this mortgage is how much bang for your buck do you get paying off that loan. So if I pay off 24 grand, I get $400 back. Whereas if I pay off the student loan 40,000, I get $400 back. Right? So which one gives you more bang for your buck for paying it off? it's obviously the auto loan, right? So it doesn't take into account interest rate, simply the balance and the payment ratio. Okay, so now let's go ahead and do this, and we'll go to 31 months, right? So this is month 31, 31, 31, 31, and figure out what the balance of these are. And then as you can see right here, the cash flow indexes do get updated, and if it's lower than 50, the theory is you want to pay it off quickly. And so let's just move these, again, under 50 right now, into the line of credit, and we'll get back a lot of cash flow in an instant. So let's just go back here, and let's go down, and I'm going to copy and paste this, and we'll do that. And then I'm going to sum this all up. So this will be F33 plus F34, right? So that's 24 grand. And I'm going to move 24 grand into here, or I should just type it in, 24019.92. Okay, so we moved in 24 grand into that line of credit, and just by simply moving that 24 grand, guess what happens? We pay off this auto loan, right? We got two auto loans, and we now have almost $25 to $100 in cash flow, which is really good. So I'm gonna go ahead and copy and paste this, and I'm gonna do this right here so I can copy our new cash flow number, and then I'm gonna do this 2479.57, and then we just keep copy and pasting, and we'll see how long it takes us to pay off those two car loans, and we'll see in 41 months. Well, blam, paid off. Is well, blam even a word? You know, I've been talking to some Gen Alpha kids, and I don't know if you ever deal with that age range group. I don't deal with them too often, but they say some weird stuff like skibbity toilet and Sigma, everything Sigma. And I was like, man, kids these days really have changed. All right, so let's go ahead and go back to here and 41 months. And so we're going to go here, pay this in 41 months. And how much is that? That's 43 plus 22 plus 24. That's 46. That's 86K, I think, if I'm doing my math correctly. 86K, 86K. And then now, probably going to focus on the student loan and then the mortgage afterwards. So let's go ahead and do that. And now these are paid off, so I don't care. I don't care. And then right now, let me go back here. 41 months, right? 41 months. What's the deal here? Okay. And then we can see that the balance of this is about 28 grand. Now, you can make an argument that we shouldn't move the whole thing into the line of credit because that cash flow index is not under 50. But I guess it depends, right? So the safest thing, and I'm going to show this off with the mortgage, is to chop your loan into little pieces, what we call chunking or incremental payoff, and then pay it off that way. But I'll just say for now, just because for the sake of time, I'll move this entire thing into the line of credit, although it might cost us a couple $100 of interest. All right, so now let's go in here. Yeah, so let's go in here, and then we move this plus 28508.85, and then now we recover another, what, $400 of cash flow? Okay, we'll do that. And then now we're at 2903.83. So I am happy that we now have so much more cash flow. So 2903.83, right? Well, let me do 83. All right. And so after 52 months, beautiful 52 months, now that's been paid off. And so we take a look right here. And then so 52 months, 86 plus 40 is 126K. That's what I'm talking about. So we got like the snowball effect going for our debt, and now what we got to do is take care of the mortgage, right? So one of the things you might have heard on the internet is that you should always replace your mortgage with a line of credit, and I'm actually going to disagree with that. And one of the reasons why I'm going to disagree with that is if this is what months are 52, 52. Okay, so if you take a look here at this cash flow index number, you look at Garrett Gunderson's website, the Wealth Factory, who created the cash flow index. He says everything over 100 you shouldn't pay off, right? Because it's quote an efficient loan, meaning that the payment amount compared to the balance is so little that you're probably better off investing in the market, or creating a better return rather than just paying it off. Now, here's the other thing too. That a high cash flow index does mean you're going to pay a lot of interest, right? Because it's such a tiny payment, yet the interest is accruing over 30 years. That's what it means. So I don't mind paying this off, but I'm just going to pay it off last. But the thing I want to mention is that if we replace this into a line of credit, so kind of like this one right here, like a $280,000 line of credit, we don't get that much cash flow back. And that's the reason why replacing a mortgage, like a really low percentage mortgage like 3%, is not really that effective, right? So that's really, if we just think of terms in purely cash flow, we get such little cash flow for paying off that debt, right? And luckily we have a velocity banking calculator to help us with this calculation, right? So let me just go ahead and open it up. Give me one moment, and I'm going to open up this velocity banking calculator right here. All right, so I think I got it. Okay, there we go. And this is a velocity banking calculator provided by Renatus. And what is Renatus? It's a online educational company, platform, communities. And this is where I first learned velocity banking from. So here's the thing. I'm going to make an offer, right? And that's what the Google form is. If you're interested in learning a little bit more than velocity banking, go ahead and click the Google form link below. Yes, it's going to cost money, but don't worry about that, because if you pay, you pay attention. And there's a reason why I'm so good at this stuff, because I paid, therefore I paid attention. All right, so now let's go ahead and fill in these numbers right here. Okay, so let me go ahead and look at that loan calculator. So originally it is a $260,000, and actually let me remove this and this. $260,000 original balance, okay? And then the current balance is 235,256.52. So it's 235,256.52. And then what percentage of it? 3%. Okay, so that's right. And what's the payment now? 1096.17. 1096.17. Okay. And then what's our income? I don't think it's $9,000. It is 6,500. 6,500. And then our living expenses is everything except for the loan we're trying to pay off. So it'll be 2,500 for our general expenses. So this is correct. And take a look here. It takes us 5.4 years to pay it off, right? Now let's do the thing where people say on the internet, let's replace our mortgage with the line of credit. So 235,256.52. Remember this number, 21 grand. Well, blam. Now we pay 77 grand, right? So we don't no need to replace the mortgage with the line of credit. So we could just do a small number, and let's just do a quick comparison too. It doesn't even have to be that big, like 9 or 10 grand. I always say, as a general rule of thumb, just make it similar to your paycheck. So 6,500, and let's see how much a big difference it makes from 9 grand to 6,500. Almost none, right? So there's a sweet spot, and I don't know if there's an exact formula for this, to be honest, but as a general rule, just your amount that's your paycheck really hasn't failed me. All right, well, that's it for today. So actually, let me go ahead and record this. So 5.4 years, and let me redo this. Do equals 52 divided by 12 plus 5.4. Okay, and that's 9.7 years. Okay, so 9.7 years to pay off how much? 260 plus 126. 386K. So remember, this is not just for the mortgage, it's for all of our entire debt. And then the mortgage took about an additional 5.4 years, right? So, um, again, more income is always better because I've done demonstrations where it's like, oh, 10 grand of income and then like $10,500 expenses and everything pays off quicker. But even if we have less income and we are positive, because in the other example it wasn't positive, it just takes a little bit longer. More income in general is always better. All right, well, that's it for today. So just hopefully this made sense. Most important things to remember is that you need a line of credit as your main operating account. You need to maximize your cash flow, and we maximize that cash flow by paying off our debt in the correct order. Credit cards come first. I've never really seen an exception to this unless it's 0%. Probably want to make minimum payments on that. Then it's the usually by done by the I'm sorry, I can't even think right now. But usually the auto loan comes next because of that cash flow index, because it's only about 5 years, and one of the main factors that determines the payment amount is the payment term. So the lower or the smaller the term, the higher the payment. So we pay these off first, then the student loan, the mortgage, and then blam, now we're debt free under 10 years and no more mortgage payment. Okay. All right. Well, that's it for today, everybody. Happy Sunday, and we'll speak next time.